everyone, and welcome to today's webinar, The Re-Emergence of a Bull Market, Finding Value in Gold. My name is Matt Hogan, and I'm the Chief Executive Officer here at InsideETFs, and your host for today's webinar. Today we're in for a real treat. Gold is the oldest investment on Earth and remains as relevant today as it was thousands of years ago. But the metal was somewhat forgotten in recent years as it pulled back from during the great bull equity market of 2008 to 2016. Gold's price has picked up nicely recently, however, as has investor interest. In today's webinar, we're going to hear whether this is sustainable. Is the rally here to stay? How should investors access this market? And more importantly, where do the best opportunities lie? Joining me to discuss this are two good friends of InsideETFs. Joe Foster is Portfolio Manager for the active VanEck Gold Fund in both the U.S. and Europe, with a track record dating back to 1998. An acknowledged authority on gold, he has more than 10 years of dedicated experience in geology and mining, including as a gold geologist in Nevada, and is one of the most respected gold portfolio managers in the world. Philip Schlegel has been Senior Director of VanEck's Switzerland office since 2010. In this capacity, he's responsible for supporting the firm's worldwide business and product development, and in particular, VanEck's European, Middle East, and Asia institutional business. The format for today's session is quite straightforward. Joe and Philip are going to spend the first 40 minutes or so running through a presentation outlining their thoughts about the gold market. It's a great presentation, extremely in-depth, and I'm sure you will enjoy it. At the end of the presentation, we'll spend some time answering your questions in a dedicated Q&A session with Joe and Philip. Before we get started, however, there's a little bit of housekeeping that we need to run through. First, I'd like to thank VanEck for sponsoring today's webinar. We love this kind of big picture, insightful content with hard-hitting research, and we could not produce it at zero cost to you without support from folks like VanEck. Second, we'd like to consider you, the listener, to be a participant in today's webinar. As such, you can and should ask questions of Joe, Philip, or myself at any time using the Q&A toggle on your webinar screen. Please don't wait until the end of our session to ask your questions. Ask them as they occur to you. I'll collate those questions and we'll answer as many as we can in the time allowed. Third, there is a lot of information on these slides. If you want to enhance the viewing area for your slide window, you may do so by either clicking the Maximize button on the upper right-hand corner of your webinar browser, or by dragging and dropping the lower right-hand corner of the webinar slides. I'd encourage you to do that now, as some of these slides are quite detailed and you don't want to miss out on anything they have embedded in there. Fourth, because people always ask, a recording of this webinar and a copy of today's slides will be made available on the ETF.com website within 48 hours of the completion of today's webinar. You'll receive an email alerting you when that recording is available. This webinar has been approved by CISI for 1 hour of CPD credit. The email alerting you that the slides are available will also contain information about the process for obtaining those credits. So if you're looking for that, sit tight after the webinar and we will get it to you. Of course, if you have any questions, you can ask us using the contact tool on ETF.com. We do have a lot to cover in today's webinar, so without further ado, I'm going to hand it over to Joe and Philip to take it away. All yours, guys.
Wonderful. Thank you very much, Matt, and thank you for having us today. I will start the presentation with a brief overview of the firm, as well as touch on our competencies in the gold mining sector before I hand over to Joe Foster. VanEck is recognized for being a pioneer in global markets and for drawing on our experience to offer innovative solutions since 1955. The firm was founded by John VanEck, the father of our current CEO, Jan VanEck, and is still 100% family-owned. The firm is headquartered in New York, where all the investment teams are based, and we have offices in Zurich, Frankfurt, Tampa, Shanghai, and Sydney. The firm's DNA in the active and passive products lies in the natural resources and gold sector, as well as emerging market equities and bonds. Back in 1968, VanEck launched their first active managed gold mining strategy that is managed by our main speaker and portfolio manager, Joe Foster, who is, as Matt already mentioned, a former geologist and undoubtedly one of the most experienced investors in this sector. The firm has always had a geologist or an engineer on the investment team to truly understand the underlying reserves and risks for these gold-producing companies. We believe this is a true differentiation factor and explains, for example, the high alpha in the active product. In 2006, VanEck launched the first ETF based on gold mining shares, the VanEck Vectors Gold Miners, followed by the VanEck Vectors Junior Gold Miners ETF in 2009. Active and passive, the firm manages over 11 billion in gold companies. That makes VanEck one of the largest in the industry. Our firm assets currently stand at 37 billion, whereby 27 billion come from our passive strategies, the VanEck Vector ETFs. Our client base is very diversified, ranging from financial intermediaries to institutional investors globally. All of the three mentioned strategies are available as UCITS-compliant vehicles. So with this said, I would like to hand over to our gold expert, Joe Foster.
Thanks, Philip, and hello, everybody. Thanks for tuning in today. On my screen, the slides aren't advancing on my screen, so I'm going to say the name of the slide I'm on so everybody knows which page I'm on when I'm referring to the slides. And we will start with slide number 10. So slide 10. So this presentation is divided into two parts. First, we're going to look at the gold market, what's driving the gold price, and where we think gold is going from here. And then we'll talk about the gold stocks. We think there's a very, very compelling case to be made for gold stocks currently. As many of you might know, we've been through a bear market between 2011 and 2015. In fact, it was one of the worst bear markets on record for gold and gold stocks. We think that bear market has come to an end, and in fact, we think we are in the early stages of a new bull market for gold. Slide number 11. I've got a number of slides to show you, some charts that support our views on gold. First, we'll look at the technical factors. Then we'll look at the macro environment and how that's supportive for gold. We'll take a look at some of the market action that we think is very important. And then we'll look at gold stock fundamentals and some of the things that are driving gold stocks. Slide number 12. This is a gold price chart. And you can see it brings out the bear market from 2011 to 2015. And in the bear market over the last several years, we've had a number of events that have created short covering rallies for gold. And you can see them highlighted with the arrows. Geopolitical risk or financial risk driving gold higher, but those rallies didn't last. They caused a $50, maybe $100 move in the gold price, but then it would fall back to make new lows. These were driven by things like events in the Ukraine or Greece or the Chinese stock market. And the reason these gold rallies didn't last is that what happens in Greece stays in Greece. It doesn't really impact the global economy or the global financial system. What's different in the recent rally in gold in 2016 is that we've had events that impact the global economy and the global financial system. We've got a situation where investors are very nervous about negative interest rates in Europe and Japan. Our financial system simply wasn't designed to operate with negative rates. So this creates some financial risk that many investors are very worried about. Also, the Fed raised rates in December, but it hasn't been able to raise rates in 2016 as it had planned. So the inability of the Fed to normalize rates also creates risk to the financial system that many investors are very worried about. And finally, as all of you know, we've had the Brexit referendum about a week ago, and that adds a whole new element of financial risk into the system that, again, people are worried about, and people are buying gold as a safe haven store of wealth to hedge against that financial risk. On page 13, this is a chart that shows a ratio of the Dow divided by gold. So keep in mind it's a ratio chart, it's not a price chart. And when this ratio is falling, the areas we've highlighted there with the arrows, when this ratio is falling, that's when gold is outperforming the Dow. This chart goes back over 100 years, so it brings out the secular bull markets in gold. The first one was in the 30s, caused by financial stress around deflation. The second one was in the 70s, again, financial stress caused by an inflationary environment. And then the more recent bull market from 2001 to 2011 was financial stress brought on by asset price inflation or asset bubbles. We had the tech bubble burst in 2000, and then we had the real estate bust in 2008 that created all kinds of financial stress. What we find interesting on this chart is if you look at the 70s, there was a mid-cycle correction from about 1974 to 1976, where gold fell and the stock market rallied because people thought inflation had gone away. But in reality, inflation came back and gold went on to new highs of over $800 an ounce in 1980. We think that we've probably just been through another mid-cycle correction from 2011 to 2015, in which the gold price fell, the stock market rallied. People thought that all the risks, the asset bubbles, the radical central bank policies that we've seen in response to the credit crisis, people felt that those risks that the market was not worried about those risks anymore. However, what we're finding this year, people are again worried about what central banks are doing with negative rates, the Brexit situation. Financial risk has come back into our economy, and that's what people are worried about. And we think that we're now seeing a resumption of the bull market that started in 2001. On page 14, we'll go through a couple of things that we think have reached turning points that favor gold in this environment. First of all, this is real rates. So this is inflation-adjusted interest rates. And you can see real rates have been on the rise since 2011. But they've rolled over and they've turned negative again this year. So we have negative real rates. At the same time, gold is trending higher. And when there are negative real rates, that's typically a very positive environment for gold. Slide 15. This is negative rates. It's not real rates. This is just nominal interest rates for sovereign debt. And this chart shows $6 trillion worth of sovereign debt that's carrying negative rates. That's actually increased. This chart was sourced in February. Today, that number is over $11 trillion. So just an incredible amount of sovereign debt is carrying negative yields today, and that creates a tremendous risk to the financial system. The dollar looks like it's topped out. There's a strong inverse correlation between the gold and dollar. And you can see the dollar has been on the rise. I'm on slide number 16. The dollar's been on the rise since 2011. But as you can see on the right-hand side of the chart, the dollar is topping out. It's been weaker lately. At the same time, gold is trending higher. So we don't think that dollar strength is any longer a headwind to the gold market. Slide 17, this is inflation. Really, inflation hasn't been driving gold for a long, long time, since the 70s really. However, if you look at the far right-hand side of this chart, inflation has been on the rise in the U.S. recently, and this could be a risk going forward. We have a tight labor market here in the U.S. It looks to us like commodities are bottoming, So it's possible that the central banks could get more inflation than they bargained for, and if that happens, that would be another positive driver for gold. Slide 18. Gold supply has stagnated. This chart shows gold mine production. And you can see the left-hand side of the chart, gold production had been increasing for a number of years. In fact, we could take this chart back 50 years, you would see gold production consistently increasing throughout that period. However, in 2014, 2015, it's looking like gold production is topped out. The gold miners simply can't find enough new gold deposits to increase production anymore. And so we've reached peak gold, and this could be a positive driver going forward as well. The market action that we think is very important. One is the flows into the gold bullion ETFs, and that's what this chart on slide 19 shows. If you look at the far right-hand side, tremendous inflows into the gold bullion ETFs this year. In fact, we haven't seen inflows like this since after the financial crisis in 2009. And this is investors and institutions, again, coming into gold to hedge their portfolios against financial risk. So this is showing tremendous investment demand in gold this year that we haven't seen for quite some time. Another look at investment demand is this chart on page 20. This is the Comex net speculative positions. And this is the futures market. So this is gold being played by the hedge funds, the CTAs, the momentum players. So this is more of the short-term money that comes into the gold market. And you can see on this chart, the bull market is shown here, a sequence of higher highs and higher lows on the left-hand side of the chart. The bear market is shown from 2011 to 2015, a trend of lower lows and lower highs. And at the far right-hand side of the chart, you can see that we've moved into a new trend, what we believe is going to be a new trend. You can see the net positions have reached new all-time highs this year on the right-hand side of the chart. And we think this chart will now, we will now start to see a series of higher highs and higher lows as we did in the bull market. So that concludes the gold portion of the presentation. I'll talk about gold stocks now, but before I do that, let me talk about our outlook for the gold market. As I said, I think we're into a new bull market. I think we'll see continued strength for the remainder of this year. I believe we'll probably test $1,400 gold by the end of the year, maybe even get through that level. That's the next big hurdle for the gold market. And then beyond that, again, I think with what central banks are doing with the negative rates, unable to normalize rates here in the U.S., now with the risk around the Brexit referendum, I think we're in an environment where there's a heightened level of financial risk, and I think investors will continue to invest in gold as a safe haven and a hedge against these risks. Moving on to gold stocks. Gold stocks had fallen out of favor over the years for several reasons. One is that they weren't able to control costs. We had tremendous cost inflation in the gold mining business. They were going for growth and building projects that didn't really make sense, that didn't generate the returns that investors expected. And as a result, some gold stocks performed poorly during the bull market and through the bear market. That's all changed. About 3 or 4 years ago, many of the major mining companies fired their top management because of poor stock price performance and poor investment decisions. They've been replaced with new management that has done a great job of getting costs down and improving their business. And I've got a few slides that bring that out. Slide number 21 shows the all-in mining costs for the gold industry. And you can see costs have come down from almost $1,200 an ounce in 2012 to almost around $900 an ounce in 2016. So a tremendous decline in mining costs. And this was caused by several things. One, we've had just a general deflation in the mining sector following the boom years that were driven by the Industrial Revolution in China. So it's just a natural deflation in costs has occurred over the last several years. Also, weak local currencies in places like Australia, Canada, Brazil, and weak local currencies also help these companies get their costs down. As you know, we've had low oil prices, so that has meant low fuel costs. And then finally, and most importantly, the companies have done a much better job of managing their mining operations. So they've engaged in better mining practices and found ways to become more efficient at the mine level, which has helped them get their costs down. Slide 22 is another type of cost chart. This shows the all-in mining costs in a cost curve. So the low-cost mines are on the left and the high-cost mines are on the right. That red line you see there is $1,205 an ounce. We're currently at $1,347 an ounce. So you can see most of the mines on that chart are making money at current gold prices, and that's a good thing. When you look at valuations, a lot of people ask us, with the tremendous increase in gold stocks this year, some of these stocks are up over 100%, so many of these stocks have doubled or more this year. People are wondering if these stocks have become too expensive. The first thing I would point out is that these stocks were oversold in the bear market. They fell out of favor with investors, and they were sold to very, very low levels. And when we gauge whether these stocks are expensive or not, we look at valuations like price to cash flow, and that's what we're showing on this chart on page 23. This is the price to cash flow of the majors and the mid-tier gold companies. And you can see on the far right-hand side of this chart how valuations have moved up this year. However, if you look towards the left-hand side of the chart, you can see that valuations are still below the long-term averages, and they're nowhere near the peak levels that we saw back in the bull market. So we still think that these stocks look attractive, even though they've had a tremendous run this year. And with the higher gold prices, these companies are generating a lot of cash flow, and we expect them to increase their dividends going forward. And with the new managements, the new practices that we're seeing put in place, I think they'll have much better capital allocation and invest in projects that generate a very good return for shareholders going forward. This chart on slide 24 shows why these gold stocks can outperform gold in a rising market. They have tremendous leverage to the gold price. This bar chart shows the majors on the left and the mid-tiers on the right. And what it tells you is that an increase in the gold price from $1,300 to $1,400 per ounce, so that's roughly a 7 or 8% increase in the gold price, results in a 38% increase in free cash flow for the majors and a 68% increase in free cash flow for the mid-tiers. So a relatively small percentage increase in gold prices generates a big increase in cash flows for these gold companies. The gold beta of these stocks has risen lately. That's what this shows in the blue lines, the GDX in dark blue and the GDXJ in light blue. These are gold equity ETFs. And you can see the betas have been trending higher since 2012, and they're up around 2 now. And what this tells us is that these stocks have better leverage to gold. They can outperform gold in a rising market with these high betas to gold. And these are betas that were typical of past markets. If you look back in the early 90s or even in the 90s or even the early 2000s, you would have seen betas up around 2. The betas had fallen through the bear market due to poor management practices, but we think these are much better run companies now. We think they can maintain these higher betas going forward. On slide 26, I'm going to give you a few examples of gold companies, some of our favorite gold stocks, and what they've been doing to improve their business and become more attractive investment vehicles. The first example here is Newmont Mining, a large cap gold stock. It's one of our favorite large caps. And the table on the left-hand side shows that through the bear market that Newmont was divesting of non-core assets, selling properties, and reinvesting in other properties with longer mine lives and lower costs. So through the bear market, Newmont's management was able to upgrade its portfolio of mines within the company. The table on the right-hand side shows that from 2012 to 2015, Newmont's costs fell from almost $1,200 an ounce down to around $850 an ounce. So a tremendous decline in cost for Newmont over the last 3 or 4 years. In addition, their net debt declined from $4.7 billion to $3.5 billion. So the company was generating enough cash to get their debt down and make them much more attractive investment proposition to many investors because of that. Slide number 27, looking at the mid-tier gold stocks, it's been a different story for the mid-tiers. They didn't get in trouble with debt like many of the majors did. So they went into the bear market with relatively clean balance sheets, and the mid-tiers were able to take advantage of the bear market and acquire new properties. And this shows the stock price performance, or the stock price chart of B2Gold, one of our favorite mid-tier stocks. You can see the stock was declining through the bear market, but even though they had a weak stock price, they were able to make acquisitions. They made 3 acquisitions that you see highlighted there, and these will be the company's growth projects going forward. That last acquisition, Papillon, is a world-class gold deposit in Mali that B2Gold is building currently and will reach production sometime next year. And this positions the company very well for growth and creating value as we embark on a new bull market. On slide 28, this is our junior gold stock example, Premier Gold, which is one of our favorite junior names. And it's similar to the mid-tiers. You can see this is a gold stock price chart, equity price chart that shows the gold stock price declining through the bear market. But again, Premier Gold had a clean balance sheet. They had cash. They were able to make acquisitions in the bear market, and these acquisitions will become their growth properties as we go into a new bull market. So this company is positioned very well for higher gold prices. Slide 29, slide 29, our last gold slide is on mergers and acquisitions. This shows M&A going back to 1998, and you can see an increase in M&A through the bull market and a decrease in M&A as we went into the bear market. There's an ongoing M&A thing in this sector. The large companies can't find enough gold to support themselves in the longer term, so they look to acquire smaller companies as acquisition targets to fill their production pipeline. And we believe that going forward, we'll probably see an increase in acquisitions. This year, companies are repairing their balance sheets. They're getting cash to invest in their projects through cash flow, and we think they'll be financially very strong as we go into 2017, and we'll probably see a cycle of acquisitions, and this will benefit many of the mid-tier and smaller gold stocks. When an acquisition occurs in this sector, the companies are usually bought at anywhere from a 20% to 50% premium to the stock price. So acquisitions can be very good for performance if you hold them in your portfolio. So just to sum up the gold stock situation, we think, again, we believe in higher gold prices, and with higher gold prices, we expect these gold stocks to outperform gold. So we think it's a very smart allocation to have some exposure to these gold stocks in a strong gold environment. With that, I'll turn it back to Matt, I guess, and see if there are any questions.
Thanks so much, Joe, and thanks, Philip, earlier. I thought that was a great presentation, awesome review of both the gold and gold mining sectors. I'd like to remind the audience that you can ask questions of the team here using the Q&A toggle at the bottom of your webinar viewing browser. We get a lot of questions, so we'll answer as many as we can in the time allotted. I guess my first question gets at the core of what your presentation covered. You covered both gold and gold mining stocks. Two questions on that. The first is, how generally should an investor choose whether to be allocated to gold or gold mining stocks? And secondly, if I'm an investor with 0% exposure to gold today, what would I sell to make room for it in my portfolio? How does it fit into an asset allocation plan?
Yeah, those are great questions. First, how do you choose between gold and a gold stock? I mean, I'm a strong believer in portfolio diversification. And within the gold sector, the way you diversify is you can have a combination of gold and gold stocks. And I think it's wise to do that because we've seen many times when gold has outperformed the gold stocks and vice versa. So it's good to be diversified. If you agree with us in our assessment that we are into a more positive gold market going forward, then you can expect the gold stock to outperform gold. And so I think when you're anticipating a stronger gold market, while it's good to be diversified, we think it's also prudent to overweight the gold stocks. If you're anticipating a weaker gold price environment, then you might overweight the gold portion, the gold bullion portion of your portfolio. As far as how do you make room in your portfolio for these gold stocks, it's up to the individual investor, as to how much they allocate to gold. But gold and gold stocks, they are volatile. They do come with some risks. So we don't. I wouldn't recommend a high allocation to gold. Most investors use gold as a form of diversification and insurance in their portfolio. Gold and gold stocks have a very low correlation with other assets like stocks and bonds. And so a small allocation of gold can give you better risk-adjusted returns over time, again, because gold doesn't correlate with other mainstream financial assets. So, to me, anything less than 5% is probably too little for any type of investment. So, 5 to 10% allocation to gold and gold stocks, I think, is very prudent for any investor. And in this environment where it's hard to make a strong case for stocks, we're getting very, very low yields from our fixed income investments these days. So I think you can rotate out of just about anything into gold stocks in the current environment and see hopefully see better returns across your portfolio with that addition.
Great, fantastic. Let's dig into those gold stocks a little bit. One question from the audience is, you mentioned gold stocks having today a beta of 2 to the gold price. First question, just explain what you mean by that. And then secondly, how have they, or why has the beta changed from presumably something closer to 1 up to 2? What does that reflect?
Okay, well, what a beta, the stock beta to gold is that's their leverage to gold. So a beta of 2 means that the stocks will double the performance of gold. So for example, if gold goes up 10% with a 2 beta, you could expect gold stocks to go up 20%. And the same thing happens in reverse. If gold goes down 10%, a 2 beta means the gold stock's going to go down 20%. So it cuts both ways. What's changed with the beta historically, these stocks have always carried a beta of around 2, but they lost it in the bull market, in the, say, I don't know, I guess post-credit crisis, in the 2008 to 2012 time frame. They lost their high beta because of their poor business practice. These companies weren't managed very well, and people looked at these gold stocks and said, well, you know, they can't meet their cost targets, they can't meet their earnings targets, they're constantly disappointing the market, not meeting expectations. We're going to forget about these gold stocks and we're going to go into the GLD, or we're going to go into the gold bullion ETFs. So the stocks fell out of favor because of poor management practices, and that caused them to lose their high beta, and that's where the beta declined to around 1. I got down to around 1.3, 1.5, somewhere in there. And again, that is all turned around. I mean, these companies are generating cash. They're making smart capital allocation decisions. They've got their costs down, and because they're better run businesses today than they were a few years ago, they've got that 2 beta back that they've had historically.
Now, Joe, why are they better run businesses? Did they just get fat during the rising gold market, or what happened to correct sort of the managerial lapses that we saw?
Mining is a tough business. These properties, these mines, they're big industrial operations, and they're located in all remote corners of the world. And you really have to keep your eye on the ball with your operations. So you have to stay on top of it and stay on top of your management teams locally. There are local issues, cultural issues, geopolitical risk issues that you have to manage. And then there are the operating issues. Mining is inherently a risky business operationally. To mine safely and consistently, you really have to have excellent management that stays on top, that can foresee problems before they happen, or if there are issues, whatever it might be. Maybe it's a slope failure at one of your mines, or maybe your recoveries are down for some reason, or there's a whole myriad of problems that can happen at a mining operation. And you have to have people that are really on top of this and can sort of nip problems in the bud. They took their eye off the ball in the bull market. They were generating lots of cash. They had lots of fast money investors telling these guys to grow and invest, and they started going for growth and building projects, spending billions of dollars on projects that didn't really make sense. And because they were focused on growth, they were not focused on their existing mining operations, and poor mining practices crept in, and their costs rose, and that's sort of the way it went in the bull market. So yeah, you're right. They took their eye off the ball, and they weren't running their operations as well as they should have.
Yep. Now, one more question into the gold mining sector, then I want to pan out to the geopolitical framework. You mentioned you have both a junior gold miners and a sort of general gold miners ETF. For someone who's not familiar with the gold mining sector, talk about the differences between those kinds of companies and the differences in the return patterns that you can expect between the juniors and the majors.
Sure. Well, we subdivide the sector into majors, mid-tiers, and juniors. The juniors is just another name for small cap. In the mining business, we call them juniors. The larger ETF, the general ETF, is a collection of small to large cap companies, but is overweighted in the larger cap companies, whereas the junior ETF is comprised mainly of juniors, and maybe a couple of mid-tiers are also included in the junior ETF. And as I mentioned in the presentation, many of the juniors and mid-tiers you can think of as acquisition targets. They are smaller companies. Many of the juniors just have one property that they're working on, and if that property is large enough and robust enough economically, then it can become an acquisition target for the larger companies. The juniors tend to have higher betas than the mid-tiers. The mid-tiers tend to have higher betas than the large caps. So they are more volatile, but they tend to outperform, the juniors would tend to outperform the larger companies in a positive gold environment. And then when we do get an increase in M&A activity, that tends to drive the juniors as well.
Fair enough. And all right, let's pan out a little bit. You know, gold often talked about as a safe haven asset. You mentioned the relationship between gold and currency exposure. What impact did we see from the Brexit on the gold sector and on gold investment appetite recently?
Well, what drives gold is a financial risk. And I guess a bit further on that, I would say systemic financial risk. So the type of risk that creates a genuine risk to the global financial system, and that's what Brexit is. You know, we don't know. First of all, I don't think the markets expected Brexit to pass. That's why we saw that volatility when it was approved. And it increases the level of financial risk globally, and it has to be something that affects global systemic, the global system. And you know, Brexit, first of all, it creates risk within the UK. So you know, we don't know how this is going to play out. This could possibly drive the UK into a recession. We hope not, but that's a possibility. We simply don't know. On a broader scale, it puts the EU at risk. So we'll see if other countries follow the UK and seek to exit the Eurozone, or does this ultimately result in a collapse of the EU itself? We simply don't know. And if some of these risks actually happen in the future, that would certainly cause a tremendous amount of stress on the global financial system. And that's why people are going to gold. It's got limited supply. It's a store of wealth. It's been a store of wealth throughout human history, and that's why people still to this day go to gold as a safe haven when they're sensing these heightened levels of financial risk. So it's not so much Brexit per se, but the effect that Brexit can potentially have on the global financial system that are causing people to look at gold.
Right. Now, of course, one big impact on Brexit that we saw the pound fall sharply. I think it had a worst day in history, or at least its worst day in 30 years, the day after Brexit. You mentioned that the U.S. dollar seemed to have topped out. But, of course, the U.S. dollar is always measured compared to other currencies. So my question is there a risk that the U.S. dollar appreciates as a safe haven currency because of Brexit? If not the U.S. dollar, what other currency do you see appreciating, and how will all that impact the price of gold as well?
Yeah, that's a great question to understand how these currencies act. The dollar is actually the first safe haven of choice. Okay, so when people get nervous about what's going on globally, they first go to the dollar as a safe haven. But when they see the dollar also at risk, and again, when risk turns global and encompasses the U.S., that's when they go to gold as an ultimate safe haven. And what we saw immediately on Brexit Day and the week following Brexit last week, the dollar was strong and gold was strong as well. So people were looking at both gold and the dollar as safe havens following Brexit. And the normal relationship between gold and the dollar is inverse. In other words, when the dollar is strong, gold tends to be weak. But that's in normal times. When we have situations like Brexit or like the credit crisis, during periods of acute financial stress, you can't have gold and the dollar rising in tandem, and that's what we've been seeing just recently post-Brexit.
Interesting. Let's stick on geopolitics here as well. Certainly for a number of years, Chinese demand was a key driver of gold. Can gold really stage a strong recovery if the Chinese economy continues to grow less quickly, or do we need strong Chinese growth to spark a real bull market in gold?
Well, Chinese demand certainly helps, and I mean, the thing about China though is that even though the economy is weak in China, we're still seeing decent gold demand out of China. 2013 was a record year. We haven't made a new record, but still demand is very firm in China the last couple of years. And I think in China, with the volatility in their stock market and their real estate market, I think a lot of people in China are seeing gold as a good store of value as well, and that's keeping demand pretty firm in China, even though the economy is weak. But what drives a gold bull market isn't what we call physical demand from India or China. It's investment demand, Western investment demand that drives gold prices higher. Demand out of China and India and other parts of Asia tend to be price sensitive. So those people don't chase the price higher. They like to buy on the dips, or they like to buy when they think they're getting a bargain. But Western demand, that's why those charts I showed you on the gold bullion ETFs and the Comex futures market, those charts are windows into Western investment demand, and that is what drives the gold price higher, and that's what we're seeing. If we were to get some strong Chinese demand on top of that for whatever reason, that would be very, very bullish for the gold market. But the Chinese tend to step back when the gold price is running and wait for a pullback.
Interesting. All right. Well, let's go back to some audience questions. We've gotten a question about silver. Silver prices moved up sharply over the past week or so. What's your view on silver? How does it fit into a precious metals portfolio? And what explains last week's strong move up to, I think, 52-week highs?
Yeah, silver has been very, very strong the last week. And silver is a monetary metal like gold. In fact, there are only two monetary metals on the planet, and the first is gold and the second is silver, because it has been used as money historically, and also it's a relatively rare metal. So as a monetary metal, the primary driver of silver is gold. Very strong correlation between gold and silver, and I see silver as a sort of a sister metal, I guess, where it will follow gold wherever it goes. The recent strength in silver, to my knowledge, there was no news in the market to justify the strong move that we saw in silver, other than that gold has been strong. Silver has lagged gold through the bear market. If we look at the gold-silver ratio, and it was at very high levels, so higher than normal. So that ratio, I think, is normalizing, and for that to normalize, you have to have some outperformance in silver. So I think silver was just doing a bit of catch-up to gold. Silver, I think of silver as a leveraged alternative to gold. It tends to be more volatile. It tends to, like gold stocks, it tends to outperform gold in a rising market and underperform gold in a falling market. So again, I think silver was just playing catch up with gold the last week or two.
And what's been happening in platinum, just to round things out on the precious metals perspective?
I don't follow platinum that closely. I don't regard it as a monetary metal. Its main use is for industrial use and jewelry. And it tends to, platinum and palladium tend to move with gold and silver, but to me they have different drivers. and again, they're not used as monetary metals like gold and silver are.
Right. I'd remind the audience you can ask questions of Joe using the Q&A toggle on your webinar screen. We have time for probably 2, maybe 3 additional questions. One note that you hit in your presentation, Joe, that stood out to me was the concept of peak gold, and you showed that chart with gold mining production having leveled off or begun to decline. I guess my question is that truly peak gold, or if we have a recovery of prices, won't we see a recovery of effort and more production come online?
We would see that, but I think it would take much higher gold prices to actually see an increase in production. Through the bull market, these companies were generating a lot of money. They were spending more than ever on exploration, but we didn't see an increase in the discovery rate. So even though they were spending by far huge record amounts on exploration, they weren't making more discoveries to drive production higher. And the simple fact is it's just gotten harder. All the easy stuff has been found, and it's gotten harder to find a large gold deposit. Once you find one, it takes longer to put it into production because of all the regulatory, environmental, social issues that you have to deal with at these properties. So it's just, it would take much higher prices. To my mind, the gold price would need to be up closer to $2,000 an ounce before we saw a significant increase in gold production.
Wow. Let me ask a question about company-specific analysis. You mentioned, for instance, that Newmont Mining is one of your favorite majors. What separates, a great company like Newmont from its peers? What are you looking at that makes it more attractive than its competitor firms?
Well, with Newmont, first of all, one of the problems that the majors had is they took on too much debt. They were in the bull market. They were building these huge projects that were very cost billions of dollars, and to fund those projects, they took on more debt than they ever have historically. So Newmont's done. When we look at Newmont's debt ratios and their debt covenants and things like that, Newmont looks healthier to us than some of the other major companies. So we like the look of Newmont's balance sheet. Secondly, Newmont has a longer mine life. As the chart showed, gold production is leveling off. So not all, how does a gold company create value? Well, it does that by building new profitable mines. But if gold production isn't rising, some companies will be able to grow, and some will actually have to contract in that environment. And so Newmont is one of the companies that has some attractive projects in the pipeline for new production. And they've again, as I showed on the charts, they've been controlling their costs. They've done a fantastic job of getting their costs down and improving their mine portfolio.
I guess my last question is, for the audience that's going to be watching the gold mining sector and the gold sector over the next 6 months, what are the sort of key signal points you're going to be watching? Are you going to be watching the Fed, the U.S. elections? What are the key inflection points? What will you be looking for, and how will those influence the price of gold?
Yeah, the market's obsessed with the Fed and the gold market as well. So that's something that we're always looking at. And I think the next, since it doesn't look like we're going to get any increases in rates out of the Fed, something we'll be looking for is further forms of easing. We've seen the European and the Japanese central banks go to negative rates. Will we see the Fed do the same thing? So that's something that we're always watching. And if the Fed does move to even easier policies, that would be a big driver for gold. Obviously, looking at how this Brexit pans out, this is going to be an unknown for months, if not years. So just looking at how the European situation evolves will be a big driver for gold, I believe. I guess as you go around the globe, I mean, China's a weak economy. Their corporate debt is sky high. So, you know, whether China can navigate through this without some sort of a debt crisis is something that markets will be looking at. The U.S. election, for sure, to my mind, that doesn't matter who wins. Both candidates would be good for gold. I think Clinton would continue the policies we've seen under Obama that have resulted in a weak economy and low productivity, increased taxes and regulations. So I think those things that are a drag on our economy would continue under Clinton administration. If Trump gets in, he is a wild card. Nobody knows what to expect out of him. So that creates a whole other set of risks. So I think wherever you look around the globe, there are potential issues and risks that could impact the economy, and those are the things that you want to key on.
Well, there you go. That's a great way to end it. Lots of potential positive drivers for gold in the months and quarters to come. You know, I do want to thank you, Joe. It's always a treat listening to you on gold and the gold mining sector. Always learn a great deal. So thank you so much for the content of today's webinar. I'd also like to thank VanEck, of course, for its support of that content. We could not produce this for you free of charge without VanEck's support. And finally, I'd like to thank the audience for your time and your commitment to your clients, your willingness to invest that time to learn more about the investment sector. Exchange-traded funds and the gold market is a testament to what you do and why you do it. As a reminder, a recording of today's webinar and a copy of the slides will be made available on the ETF.com website within 48 hours of today's webinar. As a participant in today's webinar, you will receive an email alerting you when those slides are available. That email will also contain information on how to qualify for the CPD credits for today's webinar. With that, I do hope you have a great rest of your day, an excellent week, and a profitable end to 2016. For now, this is Matt Hogan, the CEO of InsideETFs, reminding you to keep your costs low, your portfolios diversified, and your risks managed with ETFs and indeed with gold and gold mining exposure. I hope everyone has a great day. Thank you for tuning in to your Inside ETFs webinar. Thanks, everyone. Thanks, Joe. Thanks, VanEck.